Thank you everyone for joining. Let's begin with the preliminary budget assumptions for next year. Could finance walk us through the overall outlook?
Certainly. Based on current market trends and forward booking pace, we are projecting moderate but stable growth next year. Our preliminary assumptions include occupancy growth from 82% to 84%, along with ADR improvement of approximately 5%. From a revenue standpoint, we expect stronger contribution from corporate accounts, MICE business, and banquet events. However, we are also forecasting continued inflationary pressure, particularly in payroll, utilities, and operating supplies. Therefore, the proposed budget focuses not only on top-line growth, but also on improving operational efficiency and GOP flow-through.
Which revenue streams do you believe have the highest growth potential next year?
I see three key growth opportunities. First, MICE business continues to show strong recovery, especially from regional corporate clients and international conferences. Second, banquet and social events have significant upside potential due to increasing demand for premium event venues. Third, direct corporate contracts should help stabilize weekday occupancy and improve ADR quality. From a strategic perspective, we should focus on higher-rated business rather than aggressively pursuing discounted volume.
How should we prioritize CapEx allocation next year?
From a finance perspective, CapEx allocation should focus on projects that directly support revenue generation, guest satisfaction, and long-term asset protection. I would prioritize three categories. First, guest room renovation upgrades, particularly soft refurbishment, and smart room technology enhancements. Second, energy efficiency investments, such as HVAC optimization, which can reduce long-term utility expenses. Third, banquet and meeting space improvements to strengthen our competitive positioning in the MICE segment. Given current market competition, selective renovation is necessary to maintain brand standards and pricing power.
What financial risks should we be most concerned about next year?
There are several key risks we should monitor closely. First, inflation remains a major concern, especially for labor costs, utilities, and imported operating supplies. Second, competitive pricing pressure may impact ADR growth if new hotel supply enters the market aggressively. Third, geopolitical and economic uncertainty could affect international travel demand. In addition, payroll cost escalation may outpace revenue growth if productivity is not managed carefully. Therefore, forecast accuracy and cost discipline will be critical next year.
Do you expect payroll costs to increase significantly next year?
Yes, I believe payroll costs will continue increasing due to market salary adjustments, higher service expectations, and ongoing labor shortages within hospitality. At this stage, we are forecasting approximately 7% payroll growth year over year. However, the focus should not only be cost reduction, but payroll optimization. We need to improve labor productivity, cross-training efficiency, and staffing flexibility while maintaining service quality aligned with Marriott standards. Sustainable manpower planning will be essential for protecting GOP margins.
What should be our top financial priority next year?
Our top priority should be achieving balanced growth. While revenue expansion remains important, we must ensure stronger conversion of revenue into profitability. That means improving cost discipline, increasing operational efficiency, and driving higher quality revenue streams. In addition, maintaining forecast accuracy and disciplined CapEx investment will be essential for long-term financial sustainability.
Can we delay some CapEx projects?
Yes, I believe certain CapEx projects can potentially be delayed, particularly those with lower operational urgency or limited short-term revenue impact. However, critical guest-facing improvements, compliance-related projects, and asset preservation initiatives should be evaluated very carefully before postponement. In hospitality, delaying essential investment for too long may negatively affect guest satisfaction, maintenance exposure, and long-term market competitiveness. The objective is prioritizing capital allocation strategically while still protecting long-term asset value and operational stability.
Is the GOP target realistic?
I believe the GOP target is achievable, but it will require strong operational discipline, stable market demand, and careful cost management execution. Revenue recovery assumptions appear reasonable based on current booking pace and market trends. Although external volatility remains a factor, labor efficiency, pricing discipline, and procurement control will all play important roles in achieving the target. The forecast should therefore remain dynamic and closely monitored throughout the year to ensure early corrective action if market conditions change.
Why are payroll assumptions so high?
Payroll assumptions are reflecting several operational realities currently affecting the hospitality market. Wage inflation, competitive labor conditions, and service standard expectations continue creating upward pressure on labor cost structure. In addition, occupancy recovery and banquet business growth require operational flexibility and sufficient staffing support. We have attempted to balance productivity improvement opportunities with realistic operational requirements to avoid negatively affecting guest experience or employee stability. The assumptions are therefore intentionally cautious rather than overly aggressive.
Will budget cuts affect guest experience?
Potentially, yes, which is why budget adjustments must remain strategic and operationally balanced. The objective should be reducing inefficiencies and discretionary spending rather than compromising guest-facing service quality. In luxury hospitality, guest experience directly impacts brand reputation, loyalty, and long-term revenue performance. Therefore, cost control initiatives should focus primarily on productivity improvement, procurement optimization, and operational efficiency rather than visible service reduction.
How aggressive should staffing control be?
Staffing control should remain disciplined but operationally realistic. Hospitality demand can fluctuate quickly, so workforce flexibility and efficient scheduling are extremely important. However, overly aggressive labor reduction may increase burnout risk, service inconsistency, and operational disruption. The goal should be optimizing productivity and staffing alignment based on business demand while still protecting service standards and employee engagement.
Should we prioritize ADR or occupancy?
I believe the strategy should focus on optimizing total revenue contribution and profitability rather than prioritizing ADR or occupancy independently. During stronger market periods, protecting ADR and rate integrity becomes particularly important for long-term positioning and GOP performance. However, during softer periods, selective occupancy growth through targeted segmentation may help improve operational leverage and ancillary revenue generation. The key is maintaining balanced revenue quality and disciplined business mix management.
How sensitive is the forecast to market competition?
The forecast remains moderately sensitive to competitive market behavior, particularly regarding pricing pressure and segment demand shifts. New supply, aggressive discounting, and changing corporate travel patterns can all affect occupancy and ADR performance relatively quickly. That's why ongoing market intelligence, dynamic pricing strategy, and close monitoring of competitor positioning are extremely important. In today's environment, forecasting accuracy depends heavily on flexibility and responsiveness to changing market conditions.